Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now, wasting too much time, I'm sorry, folks, Richard Clarida of Columbia University of PIMCO, and of course, the former vice chairman of the Fed. Professor Clarida, we're thrilled to have you in today. Can I go nerd for a moment?
Sure.
Okay, I never talk about the Nobel Prize in economics. It's like bad luck, and I'm not doing that with somebody qualified to get the call from Scandinavia. But I want to go back. This is really important, Richard Clarida. Yeah. There can be, like in 1980, I've had the honor of talking to Joe Stiglitz about Grossman-Stiglitz, which in 1980, I'm not kidding, folks, it was like a 4-page paper. It was small. It was focused. And then with you, and, I don't want to get into, this or that, there's Clarida, Gertler, and Galdi, okay, up at Brown University. When you make a paper like that is treasured by, this is on DSGE, folks, it's treasured by all of economics, how do you get that paper done that ends up being like, hey, should they win a Nobel Prize? What was the process of doing, name the paper, but I'll go Clarida, Gertler, The Science of Monetary Policy is just one example.
Well, it was an interesting time because the authors, Mark Gertler, Jordy Galli, and I were sort of either early or late, but we felt there was a vacuum in academic economics in that it treated monetary policy as a black box. And we thought, these guys are trying to do something sensible. So we actually worked out essentially a forward-looking Taylor rule to describe actual monetary policy. And it turned out that it actually did a good job, and it made a lot more sense than the black box. But when we wrote that paper, I don't think we had any idea that it would have the impact that it did. We thought it could get ignored.
Okay, away from you and a modern economics, there's a 19th century what's called plug and chug, which is you have an equation, folks, and you fill in the little blanks of the algebraic equation. The Taylor rule, you can't do that because you don't know where the output gap is right now.
Yeah.
Is Jerome Powell flying blind?
Well, he's certainly flying with an obscured vision out the cockpit for sure. And I think there's always some uncertainty about things like what is R-star, what's the full natural rate of unemployment, but it's probably elevated now. And the stakes, let's be honest, I guess let me cut to the punchline. The stakes are higher now because of the fact that for the last 4 years, inflation's been above target. And of course, in 2021 and 2022, it surged and was not transitory. And so I would argue that the stakes are higher now for the Fed than they have been really going back to Paul Volcker 40 years ago.
Does the government shutdown impact the Fed's ability to manage its mandate here in terms of managing interest rates?
The longer it goes on, the more that becomes a factor. In particular, because a lot of the data comes from the government, including, inflation data and the labor market data. Now, the Fed, like many other organizations and in the private sector, looks at a wide range of high-frequency data. You get ADP, you get a lot of different indicators of the labor market. But yes, the longer this goes on, the more challenging it is to determine exactly where the economy is.
What do you think is the bigger risk for this economy? Is it from the Fed's perspective? Is it the labor market? Is it inflation? Are they evenly balanced here? What do you think the bigger risk is?
Well, that was what was important about the September meeting, because up until September, Jay Powell and many on the committee had said, look, we have dual mandate, employment and inflation, and they seem to be roughly in balance. And at the September meeting, they said, we're now more concerned about the balance of risk in the labor market. And I respect that, but the reality is inflation now, using the Fed's preferred measure, is 2.9%. That's where it was 18 months ago. It's well above 2. And so there is a risk to both sides. There's a risk if you don't cut rates, the unemployment rate goes up a lot. There is a risk that if you do cut rates, a year from now, inflation's stuck in the threes.
Richard Clarida with us talks, the former vice chairman of the Fed, for an extensive conversation. When we invented this, Paul, I mean, to go from Mandeep Singh with his brilliance on AI to Professor Clarida, I mean, this is the way you roll.
This is how you do it.
This is how you do it. We say good morning to all of you across America, worldwide as well. Okay, I'm in the basement of the our building in London with a guy named Jean-Claude Trichet, the engineer from Lyon. He's brilliant. He goes, Tom, I think he called me Thomas. I can't remember. And he says, it is about diffusion. And we're talking about productivity. I hate the phrase K-shaped economy because it implies a symmetric distribution. Yeah. Baloney. The productivity that we're all witnessing right now, maybe Jeff Sachs would be good at this.
Yeah.
The productivity that we're witnessing, you can't tell me it's evenly diffused across America.
Oh, certainly not.
How asymmetric are we in this productivity boom?
Well, I think you're 100% right. The term in economics, is it labor augmenting technical change? And I think the answer is yes. But more labor is augmented and other labor over time may be substituted for. And I think that is really the potential disruption from AI is not only does it lift output per hour, but it also could result in, at some point, in some displacement as well. So I think it's too soon to tell. But at minimum, we know it's not evenly distributed.
Dominic Constam over at Mizzou now, brilliant out of Oxford.
Yeah.
Dr. Constam would say there's a capital deepening issue here. Explain to our audience this wall of AI money and what that does to the capital dynamics of America.
Well, the interesting point is, remember a couple decades ago, the talk in the U.S. was about the weightless economy, that we could get all this GDP without bricks and mortar. And it turns out that at least for this part of the new economy, you need a lot of bricks, a lot of mortar, a lot of servers, and a lot of power generation. So in some ways, to get to the very new economy, you need old economy capital spending. And that's a pretty interesting period to be in. We think it's going to go on for 5-10 years, but it's a different economy than we're used to thinking about in the last 20 years.
You strip out the AI spend, a lot of folks will tell you this economy is not that strong. The capital spending is not that good. How do you think about that?
Arithmetically, that's correct. In the first half of the year, GDP growth was about 1.6, 1.7. If you strip out tech investment, then it was somewhere between 0 and half of that. Okay. You have to adjust for imports. But clearly, in the first half of the year, it's really been an AI-driven CapEx economy.
So one of the issues out there that I guess has gotten pushed to the background a little bit, maybe just because of fatigue, is tariffs and the impact on the economy. We have not necessarily seen meaningful inflation resulting from the tariffs. Growth seems to be kind of hanging in there. We had a strong GDP print a few weeks ago. How do you think tariffs will impact the economy, if at all?
The economy has been refreshingly and surprisingly resilient. I don't think there's any doubt about that. Certainly at PIMCO, we've revised up our outlook. Atlanta Fed is now saying Q3 could come in at north of 3%. So I actually think it in part is because of, at the same time we've had the tariff hit to the economy, we've also had a justifiable optimism about tech and capital spending. So that's been an important feature. I think the other important feature is that some of the tariffs have been absorbed either by the profits of U.S. companies that had a lot of profits to absorb or foreign exporters. And then the third piece is we're probably not yet at the end point of tariffs. They will continue to show up in the inflation data at least for a while. But I think increasingly I and the Fed are of the view, and that the Fed's what's important, that this is really not going to be an inflationary story. It's a price level adjustment that we're sort of in the middle innings of getting through.
Again, some nerd knowledge here, folks. Good morning, Global Wall Street. Richard Clarida with us with PIMCO, and of course, forever with his Columbia University. Okay, my path in foreign exchange is Mundell Fleming, Jacob Frankel out of Chicago, a guy named Rogoff shows up, then Rudy Dornbush up at NBT, and this upstart Rogoff and some guy named Opsfeld out at Berkeley, they show up, and it goes on and on and on. Let's take it back to Columbia, where you have this incredible, that you helped build, this incredible synthesis of international economics. Explain to America what Xavier Salih Martin or Robert Mundell, the giant, would say about how screwed up, messed up Japan is with weak yen, log convex interest rates moving higher. The real wage chart published out of Tokyo today by Bloomberg is grim. Explain why our listeners and viewers should care about the fragility of Japan.
Well, because Japan is obviously a major economy, but it's also an even bigger part of, international financial system, with the yen an important currency, especially in risk-off episodes. Somebody has to hold all the JGBs that the government has been issuing. And so what happens in Japan also spills over into U.S. capital markets and the global economy. And I think what's important for the listeners to understand now is that markets and investors have had sort of a rule of thumb about Japan, which is it sort of goes off on its own. It's got deflation. Eventually, they'll figure out their fiscal situation. And now Japan has broken out of deflation. They now have inflation. They have positive interest rates. And they're now very much a player in the global financial system.
Is there any precedent for a successful reflation? I don't see it in the literature. It's original to Japan, isn't it?
Well, Japan went through about a 2-decade period where they had deflation. Now, it wasn't a spiral, but prices were negative. I think, to me, Tom, one of the interesting things about Japan is, although the BOJ was trying to reflate the economy, the politicians and the public actually didn't get a vote. They actually like deflation. If you've got your savings in yen under the mattress, deflation is good for you. So I think a challenge right now in Japan is they finally, after 25 years, achieved the positive 2 or 3% inflation, but it's creating substantial political tension as well.
Paul, I can't emphasize that. That was brilliant. We'll try to do that single best idea. We'll see if the interns get the cut today. Paul, the societal change. I was at the White House Correspondents' Dinner, and you got this whole security idiocy because the president's there. And Martin Feldstein standing in front of me. I think Rogoff was my guest. Marty Feldstein standing in front of me. And we'd all had 6 martinis. And he turns around and he says, Tom, Japan has been lost for 2 decades.
Yeah.
That was the societal struggle.
Is Japan now found? Is it out of the wilderness at this point, do you think?
Well, as I mentioned, narrowly, it certainly is no longer in deflation. It has positive interest. I will say just an anecdote, if I'm allowed an anecdote. I visit Japan almost every year for the last 30 years. And most recently this summer, I was struck by not only the boom in the economy, but it is a real tourist magnet now. In fact, if anything in Japan, the politics is such that there are too many tourists, which is a problem they did not have for 25 years.
Professor, I got to ask you, or I should say Vice Chairman, I've got to ask you, Lisa Cook gets an extended stay at the Fed. What is the significance of Lisa Cook remaining at the Federal Reserve table?
Well, obviously the case is at the Supreme Court, and so we'll know next year where they end up. But what's important is, she continues to serve as a governor and continues to vote on monetary policy, and I think that is I think that's appropriate.
Did Columbia pay for Salah E. Martin's bright-colored jackets? Is that part of his deal?
During my time as chair, we did not subsidize the jackets or the M&Ms that he distributes to class. But I'm not sure about the current practice.
You're at Davos. Salah Martin's like 3/4 of a mile away, and he's there in bright orange. It's like, there's the growth guy from Columbia. Richard Clarida, brilliant. Thank you so much. Really treasure the comments there. Maybe we'll get him back once we figure out who Scandinavia anoints this week as well. Clarida is with PIMCO. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube. Joining us now, finally, Jane Foley, head of FX strategy at Rabobank in London. I can't say enough, folks, about the difference here in that Rabobank of the Netherlands, they go back to commercial hedging utilizing foreign exchange back centuries. It's a whole different twist here on the dynamics. Jane Foley, I want you to explain the so what to our American listeners and viewers, and those in London, frankly, as well, of a weak Japanese yen out 2.9 standard deviations. Why do I care that dollar yen could go to 155, shockingly weak Japan?
Well, I mean, certainly, excuse me, that's the talk this morning that we could see a move back to 155. And it is all because the market thinks, the yen carry trade is back on. We're going to not get the Bank of Japan interest rate hike in October after all. But I would warn that I think this is a really dangerous strategy. And
why is it dangerous?
Because if you think about the position of the LDP leader now, and she is, of course, quite likely to be voted in as the prime minister maybe next week, although there's some issues there with her coalition. But assuming she is the prime minister, you've got to wonder, does she actually want a weaker yen? Now, the market is assuming that she is going to follow the policies of her mentor, Abe. But of course, when Abe was the prime minister, things were very different in Japan. They were still trying to fight deflation. Now, Japan has got inflation, and she is very concerned that a lot of this inflation is because of imported inflation. And of course, if you are worried about imported inflation, why would you want a weaker currency, particularly when you want to build a strong relationship with President Trump, who, according to the Japanese press, may stop at Japan in his visit to Asia, perhaps at the end of this month. So I think this could be quite a dangerous strategy. I'm not quite so certain that the carry trade will be on for long.
And Paul, Toru Fujioka off our Tokyo desk has a brilliant story today showing the new inflation, the inflation-adjusted wages. The Japan people are flat on. If that happened in America, there'd literally be revolt. They're flat on their back with a negative real wage growth.
Absolutely. Jane, we've got, I think the story maybe this week, certainly this year, has been gold. We've got gold north of $4,000 per ounce. A lot of folks are saying, hey, this is a safe haven, maybe more so than the U.S. dollar. What are folks in your world thinking about the relationship between the U.S. dollar and gold?
Well, certainly that seems to be, the fashion trade right now. But I do think that there is room for both. And I do think that if we did have, say, a sudden step up of geopolitical concerns, I think we'd see the dollar and we'd see gold rallying. Although every time the dollar, if the dollar were to recover significantly, of course, I think there would be profit taking, first of all, in gold. Now, gold, I think, is a real true diversification trade this year. And I think this is where a lot of the buying has come from. If we go back to the first 5 months of this year, there was this rotation trade away from US assets. And maybe that's stopped now, paused, turned around, because we do see, the AI trade, the S&P making, such strong gains really since June. But I think there is diversification still amongst that. We've seen various different stock markets, including EM, perform quite well this year. And we've seen silver do well. We've seen Bitcoin do well. And I think there is a want by many investors really to diversify their portfolios. And I think that's where the strength in gold is coming from.
Jane, we've seen the Bloomberg dollar index, kind of stabilize here over the last month or two here. The dollar stabilized. Is this kind of a new level, do you think, for the dollar?
Yeah, the dollar is the best performing G10 currency on the 1 month view, despite the fact that it's still the worst performing on the year to date. And we have seen a lot of stability really over the summer months, really since sort of July-ish. And, a lot has been said over the spring about the hedging strategies or the change in hedging strategies by non-US dollar based fund managers. And that probably accelerated the downside of the dollar, certainly through the spring. But if we assume that for now, that's done. Maybe it could start again. But if we assume it's done, I think what we've got now is short covering in the dollar because there's an awful lot of Fed easing in the price. The market's still a little concerned about whether or not inflation will come through.
Too much jargon here. Let's translate this. Jane, you're saying everybody bet the bank, bet the farm, that there would be strong dollar, and now they're turning that trade around and going the other way?
It seems that's what happened in the spring. So if we go back to the global financial crisis, we've seen, since then, a massive rally, outperformance of the S&P 500, and really a massive rally in the value of the US dollar. So everyone was buying American assets. And during that period, non-dollar-based assets, so really Asian, European fund managers, they were investing a lot more money. There was a lot more money to be invested. And a lot of that was finding its way into the US. And I think come the beginning of this this year, the market thought, the dollar's done so well in recent years, we weren't that hedged. And at the start of this year, they started to hedge the dollars.
Jane, we're running out of time. First of all, we got to get you in the studio in New York to do like a double barrel, like a whole half hour with Jane Foley at Rabobank. Jane, people think I got hired at Bloomberg because of my bow tie. It's not true, folks. I'm in meetings with like Matt Winkler, Peter Grauer, our retiring chairman, and they're going, dazzle our rods and cones. Where do you do that? You do that in Jane Foley's space, foreign exchange. Jane, I'm seeing huge tension. If I look at something obscure like sterling Swissy, I'm out strong Swiss franc to new territory, new points of tension. If I look at euro yen back up to a 177, weak yen, points of tension. In your world, what do those tensions mean in foreign exchange for the stock market, for the bond market?
Well, I mean, the Nikkei 225 has performed really quite well this year, but if you're an overseas investor investing in Japanese assets, well, you're not going to really like the yen going lower. Now, the yen, again, seems out of place here because what we've seen is some safe haven assets doing quite well. The dollar stabilizing, the Swiss franc doing well, gold doing well, but the yen, again, on the back foot. And that, to me, is another reason why this yen sell-off is probably overdone.
Okay, Jane Foley, thank you so much. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Here's the way it rolls, folks. Economics, finance, investment, international relations. It's no different than sports, entertainment. Taylor Swift, did you know she has a new album out?
I heard that.
I think we're efforting her right now, Miss Swift, if you're listening. Bring Jack with you as well, Taylor. Anyways, people keep score. And there's a young kid that came out of York, University of York in England, and all of a sudden things are working. He's with Capital Economics, which is a really wonderful firm writing clear stuff. He's group chief economist at Capital Economics, but really made a splash, like with the FT, in the thinking within England of what in God's name is going on. The summary of it is a wonderful 250 pages, The Fractured Age. Martin Wolf warbles gaily on the cover. A guy named Robert Niblett at Chatham House shows up. So does Brad Setzer. Neil Shearing with us in celebration of The Fractured Age. Did you time the book release for the world falling apart?
You need certain things with writing the book, don't you? You need an idea, you need the support of your friends and family, and you need a bit of luck. And I've had luck in spades with this administration.
What is the distinction of this fractured age that's not in the zeitgeist now? All the 18 newspapers, the media, people like us, what are we missing of this fractured age?
So I think that the genesis of the book was that the rhetoric of deglobalization was everywhere, right? Tariffs going up, trade barriers going up, this idea that we're returning to the 1930s, countries are turning inwards. And when we at Capital Economics looked at the data, we saw global trade volumes going up year on year on year. So this idea, the thing that everyone's missing is the idea that the world isn't deglobalizing, but clearly something is changing. And as I argue in the book, and as we've written about at Capital Economics, the thing that has shifted is the relationship between the world's two major economies, the US and China. They've become superpower rivals, and that's causing those economies to both pull apart or fracture, and then other economies to have to pick a side, essentially.
So, again, we all grew up in a world of globalization. That's several generations have grown up in that world. Is that still the world we're in terms of globalization? Because it doesn't feel that way.
Well, globalization has certainly shifted, and if you look at trade flows, you can see the evidence of that shifting globalization. Okay. So, up to about 4 years ago, about 3/4 of US cell phones came from China. Less than 1 in 4 cell phones are going to be produced in China that are consumed in the US this year, with more coming from Vietnam and India. So we're still consuming vast amounts of cell phones and imported vast amounts of cell phones, but the location of the production is shifting, and it's shifting for these security reasons.
Can the global economy truly be global if there is this seemingly broadening divide between China and the West?
Well, there's going to be greater frictions within global trade and capital flows and technology flows, maybe people flows too. As I argue in the book, the key the key driver of the economic consequences of this fracturing is going to be twofold. One is, how do other countries align? Can the US bloc, which is enormous, kind of hold together, or does Trump push everyone apart? And then the second, as you allude to, Paul, is the contours of the fracturing. If it's contained to things like cell phones and batteries and chips and semiconductors and pharmaceutical products, then I think the economic costs are going to be quite limited. They'll be manageable. If we get a much wider fracturing that encompasses many more areas, then the economic costs will be much larger. And if the two sides ever come to conflict, then all bets are off. We shouldn't worry about the economic costs.
Now, sharing with us, The Fractured Age is the book, 250 pages. Mr. Wolf over at Financial Times says an exceptionally sensible, clear-headed, and original thinker. I'll vote for that as well. One of your capital economics essay is Europe flat on its back. We see that with the politics of France. And I looked at sterling Swissy today, and my word, it looks like Britain after World War II. How fragile is the continental and United Kingdom economy right now?
I think you put the UK to one side. The UK, we have our own fiscal challenges, but actually I don't think they're quite as acute as, say, France. There's plans underway to reduce the deficit in the UK. The question is really...
You're optimistic the UK can get it done?
I think we can muddle our way through. There's enough fiscal fudge going around that we can kind of muddle our way through this one. France, it seems to me, is a bit more intractable. They've had 4 governments now fall on the back of efforts to try to reduce the budget deficit. The parliament is fractured. There's a presidential election due in 2027. All of this political dysfunction is fodder for nationalist populists, and let's see what happens in the 2027 election. I don't think we're going to have a repeat of the Eurozone crisis. I don't think we're going to get big debt defaults and banking crises. The banks in France look pretty well capitalized. They don't hold much government debt, but it's a fiscal crisis that is brewing in France.
What happens if the right takes over in France? I mean, within the 5-party parliamentary system, the right in Hungary, the right in Poland, there's a huge fear almost of it, I'll call it a Trumpian right in Europe.
Absolutely, and we're seeing it happen as well. We're seeing this play out in real life. Now, I think the question is what type of rights that might govern. Italy's an interesting example here. We've had a kind of populist right-wing government for the last couple of years under Giorgia Meloni. Actually, they've governed in economic matters in a relatively orthodox way. So I think it depends as much upon how they govern if they win power as to what the rhetoric.
Do you think this is a seminal point for France right now to either stay the course and hope for the best or make some significant changes? Is this a pivot moment?
I think we're approaching one of those pivot moments, certainly when it comes to the political structure of France. If you look at the rise of the right and you look at the rise of the right across Europe, I mean, the centre's kind of holding so far. The centre held in the German elections last year. The centre's held so far in France. The question is, would it continue to hold through to 2027 in those elections?
You're Shearing on the government shutdown of the United States of America.
Well, I've just spent 2 hours. I flew into Dallas on Monday evening. I spent 2.5 hours at immigration because obviously...
There we go. Yeah, Did you say hello to Lisa Mateo?
Exactly. So it's it's having a real world consequence. Now, in terms of the impact on the economy, when we look through the history of government shutdowns, we can't really see them in the economic data. It tends to be a bit of dislocation that gets made up in subsequent months. But again, a bit like France, this speaks to political dysfunction, and it's as acute here in the US as it is in Europe.
Right. Congratulations, Neil Shearing, The Fractured Age. Can't say enough about it. Really an abrupt read and well-timed, to say the least. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
A special moment here for Bloomberg Surveillance this morning, our essay of the year. I'm thrilled to announce this. We'll do that here in a moment. Stay with us across America, around the world. Can I just suggest this hour of Bloomberg Surveillance? Sponsored by Generous Electric of Pittsfield,
Why not?
Massachusetts. We'll do that
Back, baby.
as well. Futures up 10, Dow futures up 138. Bloomberg surveillance this morning brought to you by IBKR. Well, the U.S. Consumer Sentiment Index exceeds 60 in October 2025. At IBKR Forecast Trader, the yes was recently at 33%. Start predicting today at ibkr.com/forecast. Last trading day for this contract is October 25. So over a decade ago, David Brooks did an essay in the New York Times. It was my essay of the year on the nerds and the smooth guys on Wall Street. It was brilliant on the cultural divide on Wall Street. I still quote it in speeches all the time. Brilliant essay. This year, my essay of the year is on the generational divide that we live every single day. Paul's living it. I'm living it. Tucker, do you have offspring?
Yeah.
Okay. Offspring as well. Joining us now with my essay of the year. This was out of the Wall Street Journal a number of days ago, and she's made a huge splash with it, is Professor Susie Welch of NYU. Is Gen Z unemployable? It has created a firestorm of comment. And I have to go to this because the last time, Susie, I think I saw you was with a guy named Jack Welch. When did you decide to go into the dark cavern of academics at NYU? What was the path? You didn't have to do this.
I did not. I had been in broadcast journalism for a bunch of years, and then I was running a small music tech company, and the pandemic brought it to its knees. And then Jack passed away, and I went up to the woods of upstate New York with all my kids and all their spouses and all of our dogs. And then the pandemic ended, and everybody went back to life. I had been cooking up in my mind a class called Becoming You, which was going to help people figure out what to do with their lives, which was what I was trying to figure out what to do with my life.
Yeah.
And I brought it to NYU Stern, to the dean there, who I knew from my previous life. And I said, I've got this class I wish I'd taken in business school that has a methodology that helps you figure out what to do with your life. And he said, well, let's try it as an experiment.
Before we get to the essay,
yes,
what reeks in this essay is academic rigidity. This is not some fancy person like Susie Welch who decided to get some cushy thing going. There was some real work involved here. This is like legit, countable academic research, isn't it?
Yes, I'm proud to say that it is. I mean, it was conducted by myself and my team, which includes all of the usual suspects of psychometricians and data analysts and so forth. So the research, I think, is, I'm really proud of it. It's rock solid.
40,000 people, 7,000 plus Gen Z types.
Yeah.
When did the shock set in over your outcome, and describe that?
Well, there's a bunch of, look, I teach Gen Z every single day. I mean, every semester I had hundreds of students. So my shock was perhaps less than the rest of the team because I'm in the room with them. Now, NYU students are not quite as representative of Gen Z as outside of NYU. These are MBAs, so they tend to have a little bit more grr going on. I think that when we saw the 2% number, which we can get to, we were all like, we checked it about 35 times because we thought that is much lower.
Define that number.
Okay.
Get to that.
So what we did is we have a tool called the Values Bridge, which we developed in our labs. And what it does is it ranks your values from 1 to 16, your personal values from 1 to 16. And so we now 75,000 people have taken this test. But at the time we did the research, it was 45,000 people. And we were able to cut it by generation. And we were able to see Gen Z's values ranked from 1 to 16. And their number one value is something we call eudaimonia, which encompasses self-care, recreation, leisure, fun employment, just
sounds like John Tucker, Paul.
I think we all know somebody who's eudaimonia is their number one value. Number 2 was authentic self-expression, voice as we call it. And number 3 was the desire to organize their life around helping other people, which is very admirable, I would say. But after I saw those top 3 values, I thought, I wonder what hiring managers are looking for, because my students are going out into the world to get hired. I have 4 adult children who are fighting out there in the world every day. So we did a separate study, and we replicated it twice after that to say, okay, here are the definitions of all the values hiring managers in knowledge industries, mainly business. It was tech. It was accounting, finance, and so forth, the consulting. What values are you looking for? And lo and behold, they were looking for the number one value of achievement, the desire to have success that other people can see. Number two was a desire for learning, stimulation, and growth. And the third value was work centrism, the desire to work hard. And when you cross-reference those two data sets, it ends up that it's just 2% of Gen Z that have the values that hiring managers are looking for.
It's interesting. I have 4 Gen Z adjacent kind of offspring. They're all employed. But they tell me their first memories of my oldest were 9/11. That's their first memory.
Yeah.
And then they had, the great financial crisis.
Right.
Their parents were impacted. Everybody's parents are impacted. And then they had the pandemic. So they've had some stuff, And I wonder if that influences kind of how they view the world.
Yeah, I think they don't want to buy into a deal that their parents bought into that didn't work out for a lot of their parents. I mean, you can come up with 100 reasons why they have these values, and they're entitled to them. I think that the problem is values have consequences, and so some of them also have affluence as a top value, and then they are very frustrated and frustrated to the point of kind of anger that they don't get to have. Affluence also is an output if you have the value of self-care, number one. So they can have their value. I don't, how they came by their values, I get it. There's a million reasons. I mean, their parents might be to blame. I mean, with the torrent of letters that came to the editor after the article ran, a lot of people had a lot of people they wanted to blame for this phenomenon.
What does corporate America do here? Does corporate America adjust, do you think? Or do the students adjust? Or do they just find some common ground, maybe?
This is the $1 million question. So I've talked to a lot of business leaders since the piece came out. And so the companies with brand equity who can go higher, the 2%, are out looking for them earlier. And one executive said to me, this is a cage match we're willing to fight. All right, they're going to go find that 2%. They know where they are. They're going to go get them earlier, and they're going to lock them down. And then other companies are going to have to figure out what to do about the fact that they're not going to be hiring young people who share their company values. And do they accommodate them, or do they try to slowly move them over to a different way of thinking? It's very hard to talk people out of their values, however.
Yeah. What do you find in the MBA program? Because you said those people kind of self-select. They want to achieve, presumably. But again, I would suspect you see some of that in your classroom.
I mean, I see a preponderance of eudaimonia, self-care being a top value. I do have MBAs, okay? And so, and in particular, the MBAs who are majoring in finance, they have a lot of the values that companies are looking for, and they're picked off pretty early. But I don't think this is true in colleges in general, and I think there's a few, and this is what I mean, is that companies are going to figure out where the 2% are, and they're going to come get them, and they're going to get them early.
So how about for these kids, though? I mean, do they recognize that maybe they are, in fact, different from certainly maybe their parents and maybe their grandparents and others?
Yes.
And
they're defiant.
And they're okay with that?
No, they're defiant. I mean, they're not just okay. They're defiant. They're like, the letters from Gen Z that I got, the emails were like, hey, shut up over there, lady, because you ruined the world. You boomer people ruined the world. And our response is this. And why would we want your values? Look what you did to us with climate change and terrorism and school shootings. You created this world. Why would we buy your version of events?
Wow, we
welcome all of you across America. It is my essay of the year. Susie Welch, professor, New York University, with us. It's in the Wall Street Journal. It's created a firestorm of comment, including from the kids in my family as well. Susie, I had the honor of talking to a guy named Jack Welch, and frankly on to Jeff Immelt as well, is the magic of the corridor from Pittsfield, Massachusetts, through Albany, out the Mohawk River Valley, every single 19th, early 20th century industrial exercise out to the great Eastman Kodak Company. GE, 1912, invented a defined benefit pension plan. Those companies, Carrier in Syracuse, Kodak in Rochester, they took care of their employees. What you're going to hear in your classroom, what I hear every day, is the loyalty has been broken because of the employers. What do employers need to do to increase that 2% to a much larger number?
I think that they can't do what they would need to do, which is promise long-term employment. I mean, people feel loyal when they feel like, okay, I'm investing my time in a company and I'm going to be here in 2 or 3 years. And my boss is going to be here in 2 or 3 years.
Full disclosure, Bloomberg LP, every day it's a privilege. I mean, that's where we come from.
Right.
The three of us in this room.
Right. Well, you have probably a sense that, look, this company is healthy and it's thriving and we're all going to be here. And I'm willing to give myself to this organization and to work the extra hours because we're all going to be here together. But for most people going into organizations, there's this constant sense of fragility, and we may not be here. I could be gone tomorrow. Why would you invest in yourself in that? And so that contract is pretty much over. Now, there are places, I think JP Morgan, Goldman Sachs, you can go and think, I could try to build my whole career here. But there's not a lot of companies like that anymore.
A lot of it is technology. There's so much technology out there, and there's so much. Is that a net positive? Like, do the kids in your class feel like that's a net positive? AI is probably all over your daily issues, with your dealings with your students. Is technology, with hindsight, a net positive or a net negative from your students' perspective?
I don't know the answer. Sometimes I think it's a real net negative in what it's done to how much we talk to each other. But I will say that my students are terrified because of AI. Yep. AI is taking the jobs they would do. AI, a first-year consultant or a first-year analyst, they're like deer in headlights. Like, what jobs are left for us? Where are our entry points? Yep. That's why technology is scary. Now, when it comes to using AI for homework, that's a totally different thing.
What is your experience there? What do you see?
When it first came out, they were using it a lot. Okay. And then as teachers, we got very savvy about how to phrase the homework, from your personal experience. And then I look at my students, I say, it's against the rules to use this on exams. And I'm asking you personally, for reasons of integrity, do not use AI. And generally they comply.
I'm in aerospace engineering at Boulder. Yeah. I got through the Great Books English course off the Cliff Notes. Did you? Is there any difference between the Cliff Notes and AI?
That's a good point. I think that AI does the thinking for them. With the Cliff Notes, usually you would then go into a classroom and you'd be forced to discuss issues. But AI, does the thinking and the talking.
Explain to me what I also see, particularly when I'm giving speeches, between the American Gen Z and the hungry is a stereotype. The hungry foreign kids, recent immigrants second. They're not buying the Gen Z thing. Well, they're focused and they're killing it in differential equations. It's stern.
All right. So this is what I want to say to that. And I want to wait till the data comes in. But we are currently running the exact same study in 3 different places. One with first generation immigrants as part of the Gen Z. Mm-hmm. And then we are attempting in a collaboration with a different school to do it for this exact study in India. And I don't know if we'll be able to do it, but in China. And I think that has implications for American competitiveness, because if it comes back that in India, 82% of Gen Z has hiring managers' values.
Right.
That's worrisome.
This Susie Welch for this, my essay of the year. It's in the Wall Street Journal on Gen Z. Thrilled she could come in to celebrate the research of it at New York University. Paul, finish it up, please.
I wonder if Gen Z, because I live with them every day, will be, if their values will change as they age, and they say, "Boy, I got a mortgage now."
Okay, values generally don't change.
Okay,
all right. Values are generally set by the time we're 25 years old, because a lot of things go into that stew. What changes is how much we express them or repress them. So I think what will happen is Gen Z will keep these values, because unless you have a seismic event, your values generally stay the same your whole life. The seismic event may be not getting a job, and then therefore they'll repress certain values, or they'll suppress them, not happily.
Do you see that as, again, you're one of the top MBA programs in the world here.
My first sponsor, first people to step up.
Well, my point is half of Global Wall Street came out of the Stern program. They're everywhere.
True. Absolutely true. Absolutely true. Yeah.
Has the student body changed there, do you think?
And my students I don't want to make generalizations, but my students who are first generation generally are in that 2%. So they're not changing anything. They've got their parents' values and they're there to win, and they are clearly already there. I don't see the change yet. Right now, I just see shock. Nobody doubts the research.
Right.
They don't know what they're going to do.
Do you give out C's? Okay, I just a vignette, folks. I had a privilege of Ruth Rebecca Struick in mathematics 100 million years ago. It was a curved grade, like in England, where it's much tougher. Yeah. Could you give Professor Welch a Tito's and Tang? That's our morning drink here. Susie, I look at the grade inflation, and it's a joke. I mean, I killed myself for a quality C in organic chemistry.
Yes, I did too. I want you to know something. I have given a C. It's not a very common thing, but what the student maybe should have gotten was different than a C. But I gave a C. It felt like a very brave and daring thing to do. I spoke to the academic dean beforehand, saying I'm giving a C.
Are you kidding me?
Yeah, because look, there's great inflation everywhere. I'd be lying to say there wasn't. Should we be giving C's? The students say, no, we got to get jobs. Please don't do that to us. But employers are not allowed to ask your GPA.
No one in the control room has ever gotten a C. That's what. No, let's go around the room.
Duke Business School back in the early 90s, you had 20 classes. And if you passed all 20, they stamp your passport and I could go back to Wall Street at twice the pay. So the saying was, 20 P's equals 60 G.
My grades mattered. My grades at Harvard Business School, my grades at Harvard, they both mattered a lot. And I worked so hard. And I did actually.
Do they work the same hard today that you lived at HBS?
I don't know because I'm not there. I've asked.
Could these kids get through Michael Porter?
At HBS right now, I got to believe it. They can. I mean, I don't know because I'm not in that classroom. I asked my friends there.
Well,
is it different?
This Bloomberg LP is managed by 20 and 30 somethings. So we're the outliers here.
Yeah.
And the smartest people running these businesses are, to me, kids. But they're so smart. They're so driven. They're so creative. I hired a bunch of them from Bloomberg Intelligence.
Yes.
I'm fine. I'm comfortable with this.
The kids are all right?
The kids are all right.
Okay, one final question at 20 seconds.
Okay.
How much hate mail have you gotten?
It's a good portion of it. I have to say, people, it's like the kill the messenger. And, it's as if I stood up and said Gen Z is unemployable at me, and they did.
Okay. I'll editorialize. What you've done is phenomenal. Susie Welch, thank you so much. My essay of the year is Gen Z, unemployable.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.